Hi everybody, this is James Tompkins and welcome to Lecture 6 of the Advanced Corporate Finance series. Anyway, today we're going to talk about a firm's decision whether or not to pay dividends. If so, how much in dividends? What are the most influential factors that impact whether or not firms choose to pay dividends? Why do some firms pay dividends? Why do some firms choose not to? And so on and so forth. So I'll begin with an agenda. I'm going to start off with what's in a lot of textbooks, and that is 3 traditional theories of dividends, and then we'll get a little bit more real world. We'll talk about dividends and firm type. We'll look at the implications of what happens when a firm changes its dividend policy. Maybe it unexpectedly raises its dividend or lowers its dividend, and that comes under the heading of dividends and signaling. And then finally, we'll look at the case of FPL. This is just a mini case where I'll give you a few facts, and that'll bring in some of the issues that we've talked about. So let me begin with 3 traditional theories of dividends. Theory number 1, hey, investors prefer high dividends. Okay, well, there are a couple different arguments here. Number 1 is, well, they need the income. Well, you might say, well, hey, if I have stock, yeah, one way I can get dividends, but get income is through dividends. But what's another way a stockholder can get income? Well, could you sell your stock? You could, right? So then a perfectly valid argument would be, well, why not sell the stock instead? What do you think? Well, I don't know if you've ever owned stock or not, but when you sell stock, are there transaction costs involved? There are, right? But in the case of dividends, you simply receive it in the form of dividend income without any transaction costs. And so a counter argument to say, well, why not pay stock instead is simply, well, hey, sell the stock and I get hit with a commission. Now, the second argument for investors prefer high dividends is what's called the bird in the hand theory. And basically this theory says, well, you know what? Hey, as an investor, I'd rather have a dividend with certainty than a capital gain with uncertainty. However, there's a flaw with this whole theory. Can you think of it? What's the flaw with saying, somehow dividends are less risky than counting on my returns with capital gains? Well, maybe this picture will help. Okay, ultimately, what is the source of risk, whether you're talking about capital gains or dividends? What's the business you're in, right? It's the assets. So if that's the fish farm business, then are you engaged in risk to hope that you sell a lot of fish from your fish farm? Sure. Are there costs involved? Sure. In the end, you're left with net income. Or what are the only 2 things a firm can do with net income? Either they can keep it, in which case we call it retained earnings, or they can pay it out in the form of dividends. And so whether we're talking about capital gains or dividends, is the ultimate source of risk the fish farm business? It is, right? If the fish farm does unexpectedly better, then would either the stock price go up, or might there be the potential for higher dividends? There might, right? Well, what if a poison gets into the fish pond and the fish die and so on and so forth? So again, risk inherent in the fish pond. Could the stock price go down? Could, right? And might they say, you know what, we can't afford to pay a dividend? They might, right? So the flaw with the bird in the hand theory is essentially that they both emanate from the same risk. Okay, another traditional dividend theory is, well, investors prefer low dividends. And the tax argument is that, well, when it comes to, at the personal level, when it comes to the difference in tax treatment between dividend income and capital gains, what has generally been taxed at a higher rate? The dividends, right? Why? Because if nothing else, can you defer taxes with capital gains by simply not selling your stock? You can, right? And so therefore, the argument where investors prefer low dividends is, you know what? If I'm going to get any kind of return out of the stock, I'd rather get it through capital gains because that's going to involve a lower tax rate for me at the personal level. And then finally, the third traditional dividend theory is that dividend policy is relevant. Now, this is going to make a lot more sense if you've looked at capital structure in perfect markets, because essentially it's the same argument. Okay, Miller and Modigliani show that dividend policy is relevant, assuming, number one, all the perfect market assumptions. And do you remember the perfect market assumptions? No taxes, no transaction costs, and no information asymmetries. And then what was the other assumption that Miller and Modigliani made with the capital structure? You remember? Basically, hey, no matter how I choose to raise my capital, or in this case, no matter what my dividend policy is, I'm going to invest in my lemonade stand. In other words, the asset investment decision is fixed. Now, what do you think they mean by dividend policy, Miller and Modigliani? Well, basically what they mean is, as far as dividend policy goes, well, it doesn't matter, it does not impact firm value whether or not I choose to pay more dividends earlier and fewer dividends later, or fewer dividends earlier and more dividends later. And the reasoning is very similar to, actually it's virtually identical to what we saw with capital structure and perfect markets. They say basically, firm value is unimpacted if no matter what I do, I'm going to invest in my lemonade stand. So if that's worth $100, that's worth $100, and that's it. And so their argument goes that, all right, well, or putting it simply, if the size of the pizza pie is fixed, does it matter, or can you magically make the pie bigger or smaller depending upon whether you have it cut into 6 slices or 8 slices? You can't, right? And so similarly, whether investors receive dividends now or later, that's the equivalent to the pie slices, the pizza pie slices. Okay? In the end, the sum total of slices is still going to equal to the size of the pizza, which is analogous to, hey, no matter what I do, I will invest in my lemonade stand, and that's worth $100. And so, again, same thought process. What that must mean is that if dividend policy does matter, if dividend policy does impact firm value, then it must be because it violates one of those assumptions. Maybe it affects the asset investment decision. Maybe it affects the amount of personal taxes paid by the investor. Maybe it affects expected bankruptcy costs, which is a type of transaction costs, or maybe it affects the information asymmetry between investors and the insiders at the company. In other words, the CEO of IBM and the public, there'll be less of a gap in information depending upon dividend policy. And so we'll be looking at some of these things. And we'll begin with dividends and firm type. Now, when it came to capital structure, how were we able to make a tax argument and link it to firm type? Well, with capital structure, was interest tax deductible? In other words, if a firm had debt, the interest on that debt, was that tax deductible at the corporate level? It was, right? Now, would a low-risk firm, you think, have a higher probability of realizing that debt tax yield or less of a probability? Will it have a higher probability, right? And so basically, from this perspective, we could make an argument. It didn't hold much water in the end, but we could make an argument for how much influence taxes had on a firm's capital structure. Now, can a similar argument be made for dividends? Remember, we're talking about the type of firm that can fully realize the debt tax yield. So we're talking about taxes at the corporate level. Is there anything such as a dividend tax yield? There isn't, right? because the dividends that companies pay out, are they paid after or before they figure out their corporate taxes? After, right? So there is no corporate dividend tax shield. And so therefore, there's no argument that links dividend policy with the type of firm. Okay, another thought process though is, but hey, we've just argued earlier, or at least one of the three traditional theories of dividends, that dividends are at a personal tax advantage, at the personal level. And that's true, right? And yet firms pay dividends. So what does this say about the importance of dividend policy when it comes to even personal taxes? Are companies saying, hey, we better pay careful attention to personal taxes when it comes to dividends if you've got some firms that pay high dividends? Does that suggest that taxes are or not the driving force? It suggests they're not, right? And so again, there does, just like capital structure, there doesn't seem to be a strong tax argument that is the driving force behind whether or not companies choose to pay dividends or choose not to pay dividends. So what we are going to find out, however, is that just like capital structure, the type of firm does seem to be the most important determinant of firm policy. And what would you guess? Would you guess these type B firms on average pay higher dividends or lower dividends than type A? Well, we're going to find out that these guys on average pay lower dividends, whereas type A pay higher dividends. Now again, when you look at this spectrum here, you got to be careful, okay? Is it possible, for example, to have a high-risk firm with lots of tangible assets? It is, right? So, for example, Delta Airlines, all their planes, are those tangible assets? They are, right? But would you suggest that Delta Airlines is a high-risk or a low-risk firm? Well, presumably a high-risk firm, right? I mean, sometimes they make a ton of money, sometimes they lose a ton of money, they've already been through a bankruptcy process and emerged from that, and so on and so forth. I mean, so you have to use judgment as we apply this thought process to what I'm calling the firm value spectrum. In any case, there are reasons in the end why these high-risk / growth firms, and by growth firms I mean firms whose value depends mostly on the present value of all future growth opportunities. So let's get into this. Okay, high risk / growth firms pay fewer dividends. Well, one argument is flotation costs. Okay, so all else being equal, do high dividends make it more likely that a firm will go to the external capital markets more often or less often? Well, presumably more often, right? Because when you pay a high dividend, is that more cash and therefore more value leaving the firm? It is, right? But what if a firm needs money? Well, if they've given a ton of it away in the form of dividends, another place to get money is to do what? Well, to go to the external capital markets. So then the next question is, all right, now when a company goes to the capital markets, let's say IBM, they decide to issue more equity. Okay, I'm not saying they do that, but let's say they decide to issue more equity. Okay, are they going to have to pay what's called flotation costs or commission or whatever to investment bankers who arrange the issuance? They are, right? And for what kind of firm do you think these flotation costs or these transaction costs are higher? Are they going to be higher for high-risk firms or for low-risk firms? Well, presumably flotation costs will be higher for higher-risk firms. And if they're higher for higher-risk firms, then all else being equal, would they prefer not to have to go to the external capital markets as often? They would, right? They'd rather say, hey, we're a high-risk firm. We'd just assume avoid going to the external capital markets more often than we need to, because whenever we go, we pay these huge commission costs huge transaction cost to investment bankers, and so we'd just to avoid that. So let's pay low or zero dividends to make that less likely. Another thought process, underinvestment. Now, if you've gone through the capital structure series, you'll know what underinvestment is, but just to remind me, do you remember what underinvestment is? Well, basically, underinvestment is when, because a firm is in financial distress, which means what? Well, they're not in bankruptcy, but they're worried about bankruptcy. So they're taking actions to try to avoid bankruptcy. So that's what financial distress is. And underinvestment says, okay, well, here I have this great asset investment opportunity, and it's positive net present value, which means all else being equal, it's expected to make money on a risk-adjusted basis, and yet I deliberately choose not to do it, not to do that asset investment decision. Let me give you an example. Let's say a software company, okay? And the success of this software company depends upon hiring software engineers and investing in R&D and bringing these scientists on board. And they've got this great product, like say Netscape. If you go back to the mid-90s, they got this great product and they know it's going to make just a ton of money, or I shouldn't say that. They expect it to make a ton of money. And yet, you know what? Because there's this dividend policy that they have where they pay high dividends and they're worried about not being able to make that dividend payment, they decide, you know what? We better not hire these scientists, or we better slow down on our software writing, and so on and so forth. Now, would that be good or bad for firm value? Be bad for firm value. Now, for what kind of firm would it be the worst for firm value? One where the value of the firm depended primarily on the present value of all of its growth opportunities. So in other words, the Netscape, when they went public in '95, what was the value of Netscape in their tangible assets? In other words, the buildings they happen to be in, or maybe own, maybe rent, or was their value in all the future software they expected to sell as Netscape came on board? Well, it's the latter, right? So in other words, a company whose value depends primarily on the present value of all those high growth opportunities, they're hurt so much more when a company is engaged in underinvestment. And underinvestment is more likely when a firm has said we'll pay high dividends, or when a firm has said we'll pay no dividends. Well, underinvestment's more likely when a firm says we'll pay high dividends, right? Because then maybe they feel obligated to pay the dividends. So they cut back on the R&D, they cut back on the software engineers, and maybe, just to illustrate with my example, Netscape never goes public. So within the first 3 minutes of them going public, they lose out on what was about $3 billion in market capitalization. And so higher dividends increase the probability of underinvestment. And the kind of firm that has more to lose with underinvestment is one whose value depends on the present value of all future growth opportunities. Okay, let's look at the opposite here. Low risk / growth firms pay higher dividends. So let's look at this argument of external capital markets and monitoring. Okay. So what type of firm that is not in financial distress is more likely to spend its shareholder money carelessly? A firm maybe that's really not growing very much. It's a cash cow, and it's got all this cash coming in consistently, but it doesn't have much to do with it. Okay, and so what kind of firm is that more likely to be? The low growth or the high growth firm? Well, presumably the low growth firm, right? And what kind of capital is better, you think, at monitoring a company's decisions and so on and so forth? When a company raises new capital or old and existing capital? Well, presumably new capital, right? I mean, look at even the process of going public. A company doesn't go public from nothing. They've already raised private capital, but then they go public. And when they go public, do they have to abide by all these regulations and put out prospectuses and open their books so the public can look at their information, according to law and so on and so forth? They do, right? And so basically, new capital, you could argue, is better monitors. And so given that a low growth or low risk firm, one that's a cash cow that's just getting all this cash, would you want them more heavily monitored as far as what they're going to do with that? You would, right? And so if they pay higher dividends, would they more likely or less likely have to go to the external capital markets more often? More likely, right? Now, there's also a free cash flow argument, okay? Again, what kind of firm, or remind me what free cash flow is. Again, this was in the capital structure lectures. Well, the finance definition is that once a firm has used up all its cash for any kind of positive net present value asset investment opportunities, and it's paid off all its obligations and so forth, and it's left over with cash, then by definition, that cash is used for what kind of NPV stuff? Either zero or negative. And so equity holders, do they like the company paying out cash? I mean, using cash for negative NPV stuff? They don't, right? I mean, that might be, hey, let's get another fleet of corporate aircraft, which we don't really need. Or let's spend our conferences in Hawaii and families are included. And even though that's not positive NPV, all of that negative NPV kind of action, ceteris paribus, or in theory, does what to the stock price? Does it boost it or drag it down? It drags it down, right? And so what kind of firm is more likely to have more free cash flow? Type A or Type B? Type A, right? Because these guys, they've got all these growth opportunities. And so, they're going to need their cash. But these guys, this could be, mature, stable, cash cow, but not a lot to do with that cash. Except maybe spend it on corporate aircraft that you don't need. And so, ceteris paribus, would the stockholders rather that the firm pay out money in dividends instead of using it on negative NPV stuff? They would, right? And so higher dividends reduce or increase cash flow. They reduce, right? And again, what kind of firm is more subject to these free cash flow problems? Well, the Type A, right? These guys that just stable cash, but not a lot to do with the cash. So those are basically arguments that suggest why Type B firms are more likely to pay low or even no dividends. And then gradually as they evolve maybe through their life cycle of firms, for example, Microsoft, okay, when it first went public in the mid-'80s, it was definitely, was it a Type B firm or a Type A firm? It's Type B, right? But then it evolved and it got very big and it became more of a cash cow and fewer growth opportunities. And now you could argue it's moved in the direction of Type A. And sure enough, Microsoft, has started paying dividends. But originally, do you think they paid any dividends? They didn't, right? So what I want to get into now, the previous discussion was about levels of dividends. Now I want to talk about dividend changes. And this comes under the text of dividends and signaling. So imagine a firm has an unexpected dividend increase. Okay, maybe they're paying $2 a share and they say, hey, we're going to pay $3 a share now, and it's unexpected. Okay, well, can you give me a happy face argument for that? Why would that signal good news? Well, what about in the context of this diagram right here? Okay, an unexpected dividend. So I've just made up these numbers. So here's the business. Maybe this is my lemonade stand or whatever. My lemonade stand, I hope to sell lemonade. But then I've got these costs. I've got to pay my wretched kids to sell the lemonade, and I've got to buy lemons and so on and so forth. And then I'm left with profit, right? And what are the only two things you can do with net income? Well, either you can keep it or you can pay it out in dividends. So if a firm announces an unexpected dividend increase, is it possible that one interpretation is, wow, this guy sold a whole lot more lemonade than expected. So instead of sales being 50, maybe they were 100. You know, and maybe costs didn't go up that much, and maybe net income was 20, right? So is that a potential good news story? It is, right? Well, what about the flip side? Okay, why might an unexpected dividend increase signal bad news? Okay, let's go ahead and look at this. Well, is it possible that, based on what we said, that the firm is going from a high growth firm to a low growth firm? That's possible, right? And what about an unexpected decrease in dividends? Would you expect that to signal good news or bad news? Or what's a bad news story? Well, the bad news story is, well, hey, gosh, the lemonade stand didn't do nearly as well. Nobody bought any lemonade, and we got stuck with all these lemons, and I still had to pay my kids, but maybe the sales were only $30, so now I made a loss, right? So we've basically got good news stories and bad news stories for dividend increases and decreases, and what do you think rules the day? So, for example, when a company unexpectedly cuts its dividend, okay, your good news might be, hey, you know, now it's a growth company. They got all these growth opportunities. But bad news is, well, they didn't sell as much lemonade as expected. What do you think on average is true? Well, basically, when a company cuts its dividend, the market reacts negatively, on average, okay? And if it increases its dividend unexpectedly, it reacts positively. So in other words, if they cut the dividend, they're more likely to believe, well, you really didn't do as well as you expected, did you? So you had your lemonade stand and you're expecting this much in sales of lemonade, but you really didn't sell as much as expected, or maybe costs got out of control. So that's basically some of the research that's out there that relates dividend changes to how the market reacts to those dividend changes and how it conveys information to the market. So what I want to do now is talk about the case of FPL, and this is based on a true story, okay? And it happened a while ago. It's a healthy utility, and what they did was, in the same announcement, they said, all right, you know what, we're going to cut our dividend by 32%, but also we're going to have a stock repurchase plan. Okay, so think about what's going on there. Okay, if there's the investor and there's the company, so there's FPL and there's the stockholder. Okay, so when they have the dividend cut, then that means that the company is keeping more cash or less cash? More cash, right? So in a way, I mean, I know this isn't exactly true, but in a way, that's like, you know, dollars with the dividend cut. In a way, that's kind of like dollars going from the stockholder to the firm. I mean, I know it's not exactly like that, but it's kind of like that in that the firm is not paying dividends that it otherwise would have. But what about the stock repurchase plan? Is that another way that a company can get cash to stockholders? It can, right? So basically, you know, dollars are going the other direction with the stock repurchase, right? Why? Because if I own, say, 100 shares of FPL and the company buys my stock, then I'm getting cash and they're getting the stock, right? So it's kind of interesting. We'll talk about this a little bit later, but basically they're making an announcement where one to some degree offsets the other, at least as far as cash flows between the firm and the stockholder. So a little bit more not information. Okay, at this point in time, this is the United States, the utility industry is facing deregulation. Okay, so FPL is not in financial distress. And so here's my question. Why would they cut their dividend when they're not in financial distress? Well, with upcoming utility deregulation, do you think there'd be more competition or less competition? Probably more competition, right? And if there's more competition, does that, for the company, suggest a riskier environment or a less risky environment? Probably riskier, right? But in addition to a riskier environment, with deregulation, would you suggest there might be more or fewer opportunities for growth? More, right? And so when you're talking about the potential for higher growth and higher risk, from what we saw earlier, does that suggest higher dividends for the firm or fewer dividends? Fewer, right? And so that's, them cutting their dividend is consistent with, if you will, the landscape for utilities changing. Now, FPL, they're facing the following decisions, right? As they go through this changing landscape, they have a dividend decision to make, they have the asset investment decision to make, and they have the capital structure decision to make. Okay, so if I were going to draw you a diagram really quickly, okay, so they've got the asset investment decision to make, they've got the capital structure decision to make, and then they've got the dividend decision to make. Okay, so here's the asset investment decision, capital structure, assets produce sales, and what do I pay out in dividends? So here's my question. In what order do you think they made these decisions? What order do you think would make sense? You think they'd make the dividend decision first, or the asset investment decision, or what? Well, presumably the asset investment decision would come first, right? Because why? I mean, isn't that a firm's business plan? I mean, do you decide first, well, I think I'll raise money, 40% debt and 6% equity, and then I'll figure out what to do with it later? You don't, right? And then they made the capital structure decision, and then they made the dividend decision. Okay, so why do the asset investment decision before the financing decision? I mean, I made the argument earlier that, yeah, I mean, it doesn't make sense to say, well, I think I'll decide on 40% debt and 6% equity, and then later I'll decide what to do with that, right? But in addition to that, do you remember this from our capital structure? I mean, do you want capital structure decisions that you made today driving what you invest in? I mean, so for example, imagine a firm moves in a higher risk direction. Maybe it's a domestic firm and they say, you know what, we're going to take our product abroad. We're going to go international. Would you suggest that's higher risk or low risk? That's higher risk, right? And then they say, all right, well, we're going to have 40% debt and 60% equity, but given the risk that they were heading in, really, maybe what they should have done is much less debt, maybe only 20% debt and 80% equity. And then because it's higher risk, they get into financial distress because high risk means you either make a lot of money or you lose a lot of money, right? And maybe things went badly. And now they're stuck with this high debt. At this point, is it too late to try to issue equity? It is, right? Because the equity holders are going to say, well, you want to get more money from us, say maybe another $100, but the first 20 is going to go to the debt holders to bring the value of their debt back up to full value. We're not going to do that. So in other words, it's too late. And if that doesn't make a lot of sense, because I really rushed it, if you go through the capital structure lectures, I get into that in a lot more detail and under capital structure and other issues in that lecture. But in any case, that's a decision that a firm, because maybe it made poor capital structure choices, they may have their hands tied and be forced to sell some great positive NPV stuff. And is that a good thing or a bad thing? It's a bad thing, right? So in other words, step one, a firm figures out the business it's in, the strategic direction it's going in. Is it going in a higher risk direction or low risk direction, so on and so forth. And then, given that, they make a capital structure or financing decision that makes sense of the business that they're in and the direction they're going in. And so why do the asset investment decision before the financing decision? Well, basically, the financing decision, this guy right here, should be supportive of the business you're in, and not vice versa. Now, why do the capital structure decision before the dividend decision? Well, what has worse consequences if you get it wrong? I mean, if you end up with too much debt and that turns out to be a bad decision, does that have more consequences? Or maybe paying out too much in dividends, does that have worse consequences? Well, if a company cuts its dividend, can the equity holders throw it into bankruptcy? They can't, right? But what if the company cannot pay its interest? Can the debt holders throw it into bankruptcy? They can, right? And so therefore, would you want to put most of your emphasis or your once the asset investment decision is made, would you then want to put your primary emphasis on the capital structure decision or the dividend decision? The capital structure, right? Why? Because there's just more to lose if you get it wrong. So what did FPL do? Well, first they look at their asset investment decision, right? So they said, all right, you know what, given our asset investment decision, we project a cash operating surplus. Notice that says operations. Is operations related to assets or financing? Assets, right? So we project an operating surplus in the next 5 years. Okay? And so even though they projected an operating surplus, because it's in higher risk, does that mean a higher variability of cash flows or a lower variability of cash flows? Higher variability, right? And so with cash flows becoming more risky on the operational side, ceteris paribus, would that be a reason to increase or decrease the percentage of their debt? Decrease, right? I mean, if this guy is getting riskier, then do you want to exacerbate it with having a high-risk capital structure, in other words, more debt? Or would you want to temper it by having less debt? You want to temper it by having less debt, right? And so they decreased their target debt, in this case, from 54 to 50%. So now they've made their operational decisions. They've made their capital structure decisions. What do you think went into their dividend decision thought process? Well, they wanted it low enough to allow financial flexibility. In other words, is it true that the higher the dividend here, that there's less retained earnings? True or false? Ceteris paribus. Less retained earnings, right? And who does retained earnings belong to? The debt holders or the equity holders? The equity holders, right? So if they have a higher dividend and they have less retained earnings, that means that this guy right here, the equity, is more than it would have been or less than it would have been? Less than it would have been, right? which means the percentage debt is higher or lower? It's higher. And when the percentage debt is higher, does that mean there's more financial flexibility, meaning they have more debt capacity, more ability to borrow, or less ability to borrow? Less ability, right? So they're thinking, all right, well, we want our dividends to be low enough such that it doesn't ruin our capital structure decisions. So we are able to maintain a certain amount of financial flexibility. But then in addition, once they set at a certain level, given the direction this company is going in, which is higher risk or lower risk? Higher risk, right? Well, would they want to be in a position down the road where they'd be forced to cut their dividend? They wouldn't, right? Because when you cut it, on average, how does the market react? Reacts negatively, right? So they wanted to just cut it that one time, that 32%, but at that level, they wanted to be low enough where, if anything down the road, they could either keep it level or maybe even increase it, okay? And that whole notion is called dividend smoothing. In other words, they pick a level, say right here, that they feel confident they can maintain, and then as the firm continues, if anything, they're happy to go up. You know, maybe they announce an increase that they feel comfortable they can sustain for a while. Because on average, the market reacts how to that? Positively or negatively? Positively. But what they don't want is to have set this original dividend level such that they would risk having to cut the dividend down the road. And so having a dividend at a low enough level to be sustainable, that's called dividend smoothing. It's one of the reasons that companies do not choose a residual dividend cash flow, dividend policy, a residual dividend policy. And do you know what a residual dividend policy is? Well, basically it's, well, you know, we'll do our asset investments and we'll pay our debt holders their interest and so on and so forth, and then whatever's left over we'll pay out in dividends. But with that kind of policy, your dividend's going to go up and down. They are, right? And when they go up and down, is the stock price going to react accordingly? It is, right? So basically, dividend smoothing was another thought process that they had. All right, let me ask you one final question, and that is, if they had not announced a stock repurchase plan, all else being equal, could they have announced a less drastic cut than the 32%? That goes back to this diagram here, right? I mean, are dollars in effect going in opposite directions? They are, right? So if they had not announced this stock repurchase plan, could they have logically said, well, you know, maybe we only need a 28% cut or a 25% cut? They could have, right? But they decided to make these announcements that had offsetting effects. And so given the adverse effect of an unexpected dividend cut, why make the percentage cut higher by also announcing a stock repurchase plan? Any thoughts? Well, number one is flexibility, okay? Because, yeah, they cut it once, and then the market's got that expectation of 32% down the road, or that new level as they announce that. But there's a lot more flexibility in if they change their mind about the stock repurchase plan. You know, companies announce stock repurchase plans all the time. Well, not all the time, but you know what I mean. And then they might change their mind. That there's dividends. There's a regularity about dividends. You know, the board of directors, at least in the United States, the board of directors will get together and typically quarterly they'll announce, all right, we approve a dividend or we don't approve a dividend. But a stock repurchase plan that level of regularity is not there. So the market is a lot more forgiving about a company that changes its mind about a stock repurchase plan because there's no formal announcement. Hey, we've changed our mind about our stock repurchase plan. It's just that periodically they'll follow through with it. Then there's taxes. Okay? With the stock repurchase plan, when you're buying stock, whoever sells their stock, they're paying taxes at a capital gains rate, which is, at least in the United States, generally been lower than taxes paid at the dividend rate. And then finally there's signaling, right? And that is, as we discussed in capital structure, when a company buys back its stock, what is one of the motivations for it to buy back its stock? Well, maybe the stock is trading at, say, $50 a share, and the company is thinking, hey, given our information, our inside information, it should really be worth $60 a share. So let's buy it back because that's a really good deal. And is the market going to figure that thought process out? They are, right? And so therefore, on average, when a company buys back its own stock, what do you think happens to a stock price? It goes up, and that's a type of signal. So in other words, when the company announced its stock repurchase plan, you could argue it's a positive signal, but when it announced its dividend cut, it was a negative signal, and so the signals were offsetting. Anyway, this was a discussion on dividend policy. Obviously, if you're in my class, we combine that with practice by doing a case. And as always, I hope this was a good learning experience. And take care.